You had $10,000 invested. The market dropped 20% in a week. Your stomach sank. Your hands were shaking. And every single voice in your head was screaming the same thing. Sell. Sell everything. Get out now before it gets worse. So you did. And 2 months later, the market recovered completely. You locked in a $2,000 loss that never needed to happen. Here is the brutal truth. The biggest threat to your portfolio is not the market. It is not inflation. It is not even bad stock picks. It is the 6 inches between your ears. Today, we are going to break down exactly how your brain is secretly sabotaging your investments, and more importantly, how to stop it. There is a famous experiment from the 1970s. 2 psychologists, Kahneman and Tversky, discovered something that changed the way we understand money forever. They found that losing $100 feels almost twice as painful as gaining $100 feels good. Let that sink in. The pain of a loss is not equal to the joy of a gain. It is more powerful. Way more powerful. They called this loss aversion, and it is hardwired into every single human brain, including yours. This is why investors hold on to losing stocks for way too long, hoping they will bounce back while selling their winning stocks too early to lock in a gain before it disappears. You are not being logical. You are being human. And that is the problem. Your brain was not designed for investing. It was designed for survival. Back when humans were running from predators, quick emotional reactions kept us alive. See a threat, feel fear, run. That system saved us for hundreds of thousands of years. But in financial markets, that same fear response destroys wealth. When prices fall, your brain reads it as danger and screams at you to escape. When prices rise, it reads excitement and urges you to chase. Economists have a name for this entire field of study. They call it behavioral finance, and once you understand it, you will never look at your own investment decisions the same way again. The question is, which specific biases are silently running your portfolio right now? Let us talk about the first major bias: recency bias. This is your brain's tendency to place way too much weight on recent events and assume they will continue forever. The market just crashed? Your brain says it will keep crashing. The market just went on a 2-year bull run. Your brain says it will never stop going up. This is why people panic sell at the bottom and buy in recklessly at the top, exactly backwards from what you should be doing. Think about March 2020. The market dropped 34% in 1 month. Millions of investors panic sold. But by August of that same year, the market had fully recovered and then some. The people who let recency bias drive their decisions locked in massive losses that long-term holders never experienced. Now here is a bias that hits a little differently: overconfidence bias. Studies show that roughly 80% of drivers think they are above average behind the wheel. Statistically, that is impossible. The same thing happens with investors. Research from Barber and Odean found that overconfident investors trade way too frequently, and all that extra trading eats into returns through fees and poor timing. The more certain you feel about a trade, the more dangerous that certainty becomes. A beginner has 3 months of experience and suddenly thinks they have cracked the market code. This is called the Dunning-Kruger effect in action. You know just enough to feel confident, but not enough to know what you still do not know. Real investors stay humble. Always. Here is one that is less obvious, but just as dangerous. Confirmation bias. Imagine you bought shares in a company you believe in. Now every article you read, every video you watch, every podcast you listen to, you unconsciously filter for information that confirms your decision was right. You ignore the red flags, you skip past the bearish analysts, you bookmark the bullish takes. Your brain is not gathering information anymore. It is building a case for the defense. Confirmation bias is why intelligent, educated people can hold terrible investments for years without ever questioning themselves. The fix? Actively seek out the opposite view. If you are bullish on a stock, go read the bear case. Sit with it. Discomfort is how good investors grow. We have to talk about herd mentality, because this one has wiped out more beginner investors than almost anything else. Humans are social creatures. We are wired to look at what the group is doing and follow it. Back on the savannah, if everyone else ran, you ran too. There was probably a predator. But in markets, when everyone is running toward something, that is usually when you should slow down and ask questions. Think about the meme stock craze, the crypto booms and busts, or the dot-com bubble. In each case, millions of people piled in because everyone else was doing it. The fear of missing out, what we call FOMO, overrode logic entirely. The crowd is not always wrong, but when they are wrong, they are catastrophically wrong. And the people who follow blindly pay the price. So how do you actually fix this? Because knowing your biases exist is only half the battle. You need a system. Step 1. Write down your investment thesis before you buy anything. Why are you buying? What would have to be true for this to work? What would have to happen for you to sell? When you write it down, you create a record that your emotional future self cannot rewrite. Step 2. Set rules in advance. Decide before a crash how much drawdown you are willing to accept. Decide before a rally when you will take profits. Rules made in calm moments override emotions made in panicked ones. Step 3. Create a cooling-off period. Before making any major investment decision, wait 48 hours. Your brain in panic mode is not the brain you want making financial calls. Here is the deeper truth behind all of this. Every bias we talked about today, loss aversion, recency bias, overconfidence, confirmation bias, herd mentality, they all have one thing in common. They make investing feel like it should be exciting, reactive, and emotional. But the investors who actually build wealth over time, they make it boring on purpose. They automate contributions. They do not check prices daily. They stick to a written plan. They zoom out. Warren Buffett has held some of his core positions for decades, not because markets are always going up in the short term, but because time and consistency beat emotion and reaction every single time. Your edge in this market is not finding the next hot stock. Your edge is learning to get out of your own way. You started this video watching someone make a $2,000 mistake in 30 seconds. Now you know exactly why that happens and what to do instead. Loss aversion, recency bias, overconfidence, confirmation bias, herd mentality.